Good morning. My name is Gad Lebanon and I'm Chief Economist North America here at the Conference Board. Welcome to our August edition of Economics Watch. For those in the US, this will provide you some material to talk about in your vacations that are about to start. And for those of us in Europe, you're probably already on a vacation, so thank you for taking an hour from your vacation to watch us. We have an exciting webcast today. We're going to talk about what's happening in the global economy, which is we're seeing some signs of slowdown, with perhaps more than a slowdown in the United Kingdom. We will talk about that a little, and then we'll move to the US and talk about the overall economic outlook, which seems to be quite strong at the moment. And we'll focus this time on consumer spending, on how economic trends and what's happening in the overall economy is impacting the outlook for consumer spending. I'll introduce my guests in a minute, but just to remind you that just a second, that there are CPE credits for that webcast. So if you want to see them, get them, you please type your full name and email address in the space provided and click OK for the 3 pop-ups that occur during the program, and stay online for the entire webcast if you want to get those credits. It's available for live participation only. Together with me in the studio, in our European studio, first Ilaria Maselli, our senior economist for Europe in the Brussels office. Good afternoon, Ilaria.
Good morning, Gad. Good morning, everyone.
Thank you. Good to have you. And here in the studio in New York with me, as usual, is Brian Shaitkin, senior economist here at the Conference Board. Good morning, Brian.
Thank you, Gad.
Good. So, as usual, we'll start with the global outlook. As I mentioned earlier, we are seeing some clouds there. Ilaria, is it just clouds or more than clouds?
I would say just clouds there, because all in all, the economy is continuing to perform well. But we start to see some countries that where there is a moderation going on, and these countries are some countries in the euro area and some other countries in emerging markets. And I will come back for more details. I think there are some interesting trends that we can outline. So in Europe, what is going on is that after the fantastic performance in 2017, in the beginning of the year, external demand started to moderate, and we know how important the export sector is for European countries, for many European countries. And then what we start to observe now, and what might continue in the future, we will discuss this in a minute in more details, is that also domestic demand might be at risk in a moment where this would be needed to compensate the lower external demand. So this is the situation, this is the reason behind the moderation on this side of the world. There is a special slide later on the UK, because this is a separate case. So in one tweet, what I can say for this introduction is that the UK is at a very high risk of recession in next month, and I will explain more why we believe this right now. In the emerging markets, again, of course, it's a different situation, but and also it's very different countries that are putting together under this group. But there is a mix of policy uncertainty and weakness in industrial production, such that also this group of countries is moderating. So to pull the global economy, we have the US, and there I'm waiting for your detailed explanation on what we can expect for the rest of the year.
Thanks, Ilaria. And before we hear from you and from us, let's hear from our audience. If we can put the first polling question. So the question today is: what will be the greatest source of global uncertainty for your business during the next year? So there are a few options: slowing euro area and emerging market growth, local political uncertainty such as Brexit and elections in India and Brazil, tighter Federal Reserve policy creating inflation and sovereign default risks, and trade policy uncertainty. So I'll give you a little more time. There are a few options here. So let's close it in 5, 4, 3, 2, 1, and the poll is closed. So trade is still on the biggest concern. 59% said that trade policy uncertainty. Number 2 is tighter Federal Reserve policy creating inflation and sovereign debt default risks. Local political uncertainty is number 3 with about 14%, and at 7% slowing euro area and emerging market growth. Ilaria, Brian, any initial thoughts about the results of the survey?
So I think my initial thought is that it's a given that our audience is concerned with trade policy uncertainty. What's, I think, becoming more recognized as the Federal Reserve increases interest rates is that for countries like Argentina and Turkey that have high dollar-denominated debts and also import a lot of goods, that's going to create a situation where the dollar is going to strengthen, prices are going to be higher, inflation is going to be higher, and therefore borrowing costs are also going to be higher. So all of those things coming together creates a degree of risk in some emerging markets. And one of the things that we observed last year that was such a source of strength in terms of economic growth in 2017, and it's not playing out quite the same way in 2018, is this idea of recessions and slowdowns being present in a very, very small number of countries. And we are seeing more countries as we move along through this global expansion experiencing the real risk of a downturn, of a severe slowdown or even a recession.
Yeah. Ilaria, any thoughts on did the results surprise you?
Just a couple of things. No, I'm not really surprised because if like the issue of trade and the risk of a trade war, I mean, no matter where you're sitting, you are closely watching this. I mean, every person in a multinational company is somehow concerned by this. So I'm not surprised that this is the response with the highest that was preferred by most of our people in the audience. The other 3 options were a bit more local. So I suspect there is a little US bias in the audience because there was a preference for the Fed changing policy. But there, again, I despite what Brian said, which is of course something to monitor, companies are probably already factoring that because the communication of the Fed is always very transparent and very clear. So to some extent, this is being factoring in the budgets and in the plans for companies for the next year. And then, of course, I would have pushed the button on Brexit because the situation is becoming very interesting right now. But again, it's because I'm sitting on this side of the world. I'm sitting in Brussels, so I look at that more closely.
Yeah. So let's continue with this theme, and you are seeing some increased recession risk.
Well, only in some countries. As I was saying at the beginning, the economy is all in all in a very good place. And I wanted to show this on this chart, which is a little bit peculiar, so I will explain that. So you can see on the 4 quadrants, the 4 phases of a business cycle. So there is the expansion, then the economy slows down, then there is a contraction, and then there is a recovery. So you can really see that for the past year, the global economy, which is what is put there on the chart, has been in a very nice place. But also, as you can see, the line moves down, so it moves away from the top of the expansion quadrant, and it's moving closer in a phase of moderation, so which is what we have been saying and we've been following in the last months. Now, of course, this is the chart. This chart refers to the global economy, but countries are taking different positions on that chart. So, very close to the line in between the expansion and the slowdown, you can find many countries like the US and Europe, and much closer to the origin. And looking further down on the slowdown, you can find countries like the UK and Brazil. So this is where we are. As I said, it's all in all a good place. But then, if we really want to know some more details, we should start looking in the details of the countries. So I'm going to start with the emerging markets, and what you can see here is the leading economic index with the 6%, with the 6 months percentage change in the index. And you have the 4 biggest emerging markets on this chart, which are China, India, Brazil, and Mexico. So the one that really strikes is of course Brazil, where the LEI has been going down since the beginning of the year, and where there is a lot of there is a combination of all of the industrial sector signaling a weakening of the economy, and combined with the political uncertainty because there were the elections in October. So there is of the 4, there is the one where the situation has been deteriorating the fastest since the beginning of the year. China is still the LEI in China is still very strong. It's the black line, so the one on the top, and their consumer confidence and business confidence are still very high, but there is a lot of uncertainty regarding the export sector, as you can imagine, because of the discussion of on the tariffs. And then there are India and Mexico. Of the 4 countries, India is the one that is doing best, because the LEI has been improving in the last couple of months. But there is some concerns regarding inflation, and indeed the Central Bank of India has been increasing interest rates to try to balance that. But there is all in all a certain the outlook for India is more positive. I mean, of these 4 is the one that is more positive. And then there is Mexico, where political uncertainty is decreasing now that the elections are over, and consumer confidence has been increasing. So the country is not doing great yet, also because of NAFTA, but there is some small improvement in the air that we can observe. So this is the situation for the 4 biggest emerging. This is in a snapshot the situation for the emerging markets. Where, as I said, the 2 interesting things that we are looking at this month are, on the one hand, the industrial production, and on the other side, the political uncertainty, because these are the 2 important things to keep an eye on at this stage.
And what about Europe?
Well, a lot to say there, because you can see also here the LEI. So this is the LEI for the blue line is the LEI for the euro area, and the yellow line is the coincident index also for the euro area. So what you can see is that the LEI has been growing really fast in 2016 and 2017, and then it continues growing, but at a slower and slower rate since the start of this year. So the economy is clearly moderating, and I think this makes a lot of sense, because the growth rates that we observed at the end of 2017, so we are talking about GDP growth in the range of 2.4%, 2.5% even. This was really far from the potential of the economy, which, just to give you a number to compare, we estimate being 1.4% the yearly GDP growth. So that was clearly not sustainable. And also it was the result of the fact that the global economy, like everyone in the global economy was doing well. The US was growing, the emerging markets were growing, trade had picked up again at the end of last year, but this was a kind of unique situation, and now this is slowly going away. So we are still in a very positive territory, and we are still on track for a 2% GDP growth in 2018. But there are a couple of things to keep an eye on. So I'll move to the next slide, because I would like to show you something. what we said, what we observed in the past months, in the past webcast also, is that external demand, so the export sector, was of course suffering in the first half of the year. And then, of course, when the export sector is suffering, the consumers' demand, the local consumers' demand becomes even more important because it has no way to compensate. And but what we see is that this might not be the case, because consumer confidence, after going up, and that's the orange line on this chart, after going up very steadily since 2013, so since the recovery started, now has started to weaken. So in January, it touched the peak. Ever since this data series is collected, never it happened before that the balance of answers between those that believe that the outlook is positive and those that believe that the outlook is negative was positive. So this balance was positive only basically for a couple of months at the beginning of the year, and then since then it's deteriorating. Now, on an historical level, we are still talking about very high levels of confidence. So it's not something really to worry about, but it's more something that we have to monitor, because it looks like retail trade might have already suffered in the beginning of the year of this minor decrease in confidence.
Ilaria, we'll get to the UK in a minute, but looking at other countries in Europe, are there any of them that we are seeing more signs of slowdown than in others?
Yes, that's a good question, Gad. And I think if we look at our LEIs, or I don't have a chart here, unfortunately, but it was in our slides, EconView slides from last month, we pointed at two countries in particular. One is Germany and the other one is Spain. So in these two countries, the LEI has been not declining, because as I said, it's still very much in positive territory, but growing at a slower and slower rate in the past months, more than in the other countries.
Mm-hmm. Okay, so let's get to the main event in terms of Europe, which is the United Kingdom, and we, perhaps more than almost any other organization, are pessimistic about the UK and about the likelihood of a recession there. Why is that the case?
So let me start from the beginning, which is the components of the LEI. So what you can see here again is the leading economic index for the UK, which, as you know, is composed by 8 sub-indicators that look at different parts of the economy. Now, first of all, the first thing is that our colleagues have put together this fantastic chart where it basically shows the LEI for a very long period of time. And so you can see that, you know, it's a business cycle, it goes up and it goes down. But then you see also this red line, which where the risk of recession is put there. So when the LEI meets this red line, it means that the risk of recession is very high. Now, there are some false positives in this analysis, in the sense that it's possible that the LEI gets close to this red line, but then a recession doesn't happen. And this was the case, for example, in the 2000s, that you can see in the middle of the chart, more or less. But we believe this is not the case this time. We believe a recession is very likely to happen in the next month, and I will try to explain why. There are two main drivers, I would say. One is the fact that the business cycle is maturing. So as simple as that. It's a bit like in the US. It's been 10 years since the last recession, and we know business cycles don't die of old age. At some point, a recession happens, and so we are, I would say, in this time frame where you need to start looking around and look closer at the data. So if you look closer at the data, what you can see is that out of the 8 components of the LEI, all the components that are related more to the non-financial economy are not doing well at all. So consumer confidence has been decreasing a lot, especially after Brexit. The housing expectations are, the housing market is not doing well, so the expectations on the housing market have been deteriorating as a consequence. And more recently, also the unemployment claims have started to increase, even though the unemployment rate is still very low. So this is one factor. So it's a long time since the last recession. Let's keep a closer eye at the data, and this is what we see. And then, of course,
quick question. So the timing. Do we expect when the recession will start?
So this is the type of question I should never answer when I'm on the record. Because somebody may come to me the next month and say hello. No, it's of course difficult. It's of course difficult to put a date, because the event that triggers a recession is rather unpredictable. But I would say that early next year might actually be the moment. We know that the LAI as a time horizon, it tries to tell us something about the economy in the next 6 months. So maybe early next year could be the time when the recession could be triggered by some sort of very unpredictable event.
Ilaria, is it more likely that that unpredictable event will be the consequences from Brexit, however terms are eventually agreed, beginning, or simply a continuation of the current scenario where there's a lot of uncertainty about both the timing and ultimate scope of a Brexit agreement?
Well, this is also very difficult to say, Brian, but I think the closer, I would say it's a kind of very strange situation, because there is still a lot of confusion. What really shocks me about Brexit is that we don't know much more today than the day after the referendum. So there is still extreme lack of clarity on the main issues of the divorce, or like even more about the future relationship actually than the divorce. But we know it's going to happen 30 March of next year. That's the day. Now, the closer we get to that date, the more it feels like the chances of a hard Brexit are higher, because the government couldn't agree on anything else, couldn't agree on anything more or less. So it's difficult to imagine that they find an agreement, because there is only 8 months left. On the other hand, I know from living in Brussels that the higher the stakes, the stronger the push to find a deal. So it's been the case many times. If you also think of the Greek crisis, that there are these last minute 3 a.m. Council communications where they announce a big change or a big rescue package or a big solution, a big deal. So it's still very difficult to say how this will end. But what is clear is that no matter, it's impossible that the UK will just have the same smooth circulation of capital and people and goods and services as now. This will change, and this change adds to the pressure from the fact that the business cycle is maturing, because it will trigger a lot of changes in the way people do their shopping, in the way companies make their decisions, in the way companies operate their supply chains. So if you put these two things together, the business cycle maturing and Brexit, then you can get convinced that the chances of a recession are very high.
No, thanks, Ilaria. That's very useful. We usually hope that common sense will prevail, but it's not always the case. And as we get closer to the March 30th date, I think that you mentioned, right? Then
yes,
the smaller chance that perhaps common sense will prevail. So I think that the main message from our international part today is that the likelihood of a recession in the UK is probably larger than you think. So with that optimistic conclusion, let's move to the US outlook, where things are a little rosier. No, Brian?
Yes, that's correct. So GDP in the second quarter was 4.2% annual rate, and we anticipate that, so combined with growth of around 2% in the first quarter. That ended up at 3.1% average for the first half of the year. And we're thinking that based on the fact that you have continued strength in terms of business and consumer confidence, that GDP is going to average a 3.3% growth rate during the second half of 2018. And that's likely to be a peak in growth for this expansion. There are a few reasons why it's going to, first of all, we're expecting such strong growth. So in addition to the confidence factors, there's also the element of policy stimulus, both fiscal policy, both government spending in the form of the bipartisan budget bill, which authorized a great deal additional federal spending that had been held back during the sequester period earlier this decade, and also the continued impact of business and individual tax cuts. In addition to that, one of the reasons why consumer confidence is indeed so strong is that the labor market continues to create jobs rapidly, and that's boosting consumer spending and could eventually trigger a tighter labor market, which may help wages accelerate at a faster pace. In addition, some of the near-term risk factors that made our outlook positive but having more downsides earlier in the year have faded. So on trade, China, the bilateral relationship with China remains a major concern for U.S. business, but concerns about a widening trade conflict that could encompass the auto sector with the EU have clearly eased. The performance of key technology companies has improved in recent weeks to the point that some of them may even be considering the possibility of going private. And we're concerned that some of those businesses might be in for a period of weaker performance. But there are a few reasons why we think that that second half of 2018 is likely to represent a peak in this particular expansion in terms of growth pace. So first of all, that federal spending increase, it's not going to increase forever. Instead, the influence of increased federal spending is going to fade out as 2019 progresses. The strength of the economy and additional wage and price pressure means that the Federal Reserve is going to continue tightening interest rates over the next 2 years. We're expecting 2 more rate increases this year, 3 more next year. And what that ends up meaning is that capital costs are going to rise, and we're already seeing the effects of those higher interest rates on housing sales. And finally, as Ilaria mentioned, the risks for individual countries in both Europe and emerging markets are increasing, and the end result of that is that U.S. exports may experience less support in terms of global sales, especially since a tighter Federal Reserve policy could continue causing the dollar to strengthen.
Brian, actually, before we go to the next slide, just so there has been a lot of discussion lately in the media after the second quarter GDP numbers came out, and in general with the strong US economy about who deserves the credit for that, and why have we seen such acceleration in the US economy. So without getting into politics, what in your opinion are the reasons why the US economy accelerated?
So I think there are a few reasons why. First of all, last year was a very strong year for the global economy, for global demand in general, and so that played a part in boosting up US demand and US confidence. Certainly, tax cuts helped raise business confidence. So even though over time capital costs are going to end up being substantially higher because the increased budget deficits are going to play a role in causing interest rates to go higher, there's going to be more strain on both the US's capital and labor resources, so the cost of both capital and labor in the form of wages will end up rising. For 2018, at least, that business confidence has helped in terms of generating investment, and also the strength of the labor market, which had been strengthening for several years. That's played a role in boosting and sustaining high consumer spending levels, and in particular, as we'll talk about later, helping in terms of the growth of spending in discretionary categories.
Yeah, right. And so confidence is an important part of the story.
Absolutely. When consumers and businesses are confident, it means more investment, more spending. The result of that is, all things being equal, higher GDP. So we do expect that economic growth is going to be able to remain around this 3% number through early 2019 before it's going to start to tail off due to some of the headwinds I described, both the global headwinds and the domestic headwinds as a result of tighter Federal Reserve policy. One thing to keep in mind in terms of thinking about why is it that we expect the U.S. economic growth to peak during the second half of 2018, a big part of that is the way in which federal spending increases that are authorized by the bipartisan budget bill passed at the beginning of this year are likely to play out. So the bill undoes a lot of the spending cuts implemented as a result of the sequester. And so that means both defense spending and non-defense spending. But within that, there's a lot of uncertainty in terms of the timing. Just because an agency has been authorized to spend more takes some time in order to begin to act upon that authority. And we anticipate that the fastest growth in terms of federal spending is going to occur during the third and fourth quarter, though there's some uncertainty. For example, disaster spending could, of course, occur at any time, perhaps due to the California wildfires, perhaps due to hurricanes. But we think that the third and fourth quarters of 2018 and the first quarter of 2019 is going to be when you see the fastest rate of federal spending growth. And so that's going to make a contribution to GDP growth that simply is not going to be there when you get into the last three quarters of 2019.
In fact, if we go for a second back to this slide, we have it here all the way to the end of 2019, but in 2020, this number is probably going to be negative. We will have less spending in 2020 than we did in 2019 because all of this, the impact of the spending bill will be over by then.
No, not quite, because the higher spending levels are still going to be authorized. And in fact, some agencies may still be spending some of their additional authority when they get out to 2020. But the pace of growth will be very slow in 2020.
Also, the rise of the federal spending is going to remain permanent.
Right,
Okay.
Or at least... yes.
Nothing is permanent.
Yes,
yeah.
Exactly. Precisely. So I think it's important to keep in mind what's happening from a consumer confidence perspective in thinking about this question of what's going to happen to growth during the rest of 2018 and 2019. So what this chart shows is both the present situation index, a measure of how consumers are feeling about the current state of the economy, and the expectations index, which is a measure of how consumers expect their personal finance conditions and economic conditions to evolve over the next few months. And what you can see is a steady increase in the present situation index, but at the same time, the expectations index has not improved further. And so what that's an indication of is that consumer spending is robust right now, but consumers do not expect the economy to strengthen further. So we can expect those consumer spending levels to remain high over the next few quarters. It's probable that expectations will start to come down as the effect of Federal Reserve policy and labor and capital constraints start coming in 2019. So that's why we expect the pace of growth to slow back towards its 2% trend in 2019. I think one key area where we're already seeing some of the effects of supply constraints playing out is in the housing market, which notably performed much worse than the economy as a whole during the second quarter. And you could see that this is not just a GDP phenomenon and not just a residential investments phenomenon. It also is playing out in the red line, which shows the 3-month average of housing starts, which has been declining in recent months. Now, one element of that is the high price of housing, particularly in the most desirable areas. But there are two other key elements. So first of all, material and component prices for construction are rising. So that's an indication that as demand for materials are increasing, that you do get higher prices, and that adds to the cost of new building. And then in addition, job vacancy rates for construction workers are at a high for this expansionary period. And so the result of that is you have fewer workers available to build houses, materials cost more, interest rates have gone up already due to Federal Reserve actions to this point, so that's raising mortgage rates. So all of those factors are combining to make house purchasing a dearer proposition, and the end result of that is slower housing purchase.
There was a question here about are any U.S. sectors at risk even in a strong economy? So I guess the housing sector is one of them, the combination of higher mortgage rate, which may impact demand, and the higher cost from the supply side. That's something that could squeeze the housing sector a little.
Oh, certainly. I think the housing sector is not necessarily at risk for a severe slowdown, for a severe reversal in demand, but definitely there are greater headwinds against the housing sector. I think one other area where there's some risk, and this applies to many, many firms, is that if you look at transportation services costs, for the same reason that we're seeing material and component prices rise, both because of global commodity prices rising, a lack of workers, and increased wages, as you'll discuss later in some blue-collar occupations, the cost of transporting goods is rising. The capacity to transport more goods as e-commerce becomes more of a factor is not rising in a commensurate way with the growth of e-commerce. And so as a result, there's a bit of a transportation glut. And so I think when we think about inflationary factors, it's not enough to just think broadly in terms of the inflation measure. It's a matter of identifying choke points through the economy. Those choke points can be created by these types of supply constraints. They can be created as a result of tariffs. I mean, already we've seen steel prices increase, and that's fed into an increase in washing machine prices as a result of tariffs directly related to washing machines. So there are going to be specific price increases that are observable throughout the economy.
I agree. I would say also in reaction to the question is that interest rates, especially short, but also long-term interest rates, are almost certainly likely to increase as the Fed continues to raise their interest rates. So any sector that is interest rate sensitive, and housing is probably the number one, is going to be impacted by that. I think auto sales are also interest rate sensitive, and we've seen some flatness, if not an outright decline in car sales. So that could also be impacted. There's another question here. How does the lack of productivity growth factor into the economic equation? Let me first take a first crack at that, and then Brian, you can add to it. I would say Well, one impact of the productivity, the lack of productivity growth, was that companies, in order to increase revenue, they needed to hire more people because they couldn't get much more out of their existing workers. And that's one of the main reasons why we've seen strong employment growth in recent years and a tightening labor market. So that's one impact. Also, when labor productivity is slower, corporate profits are suffering from that. So those are some of the main impacts. I would say that we are seeing some glimmering or green shoots of perhaps some acceleration in labor productivity in the past year. As the labor market gets tighter and labor cost is accelerating, there is more pressure on companies to do more with less and to automate. So we are perhaps finally seeing some acceleration, but it's still too early to be confident about that.
Yeah, I think that's an excellent way of describing it, Gad, because what the key to further productivity growth is what is happening on the investment end. And what we can see in this chart is that equipment growth has fallen off a bit, though we anticipate due to new orders, a pickup in new orders data that will improve in the second half. But what I want to draw your attention to is the green line, which is intellectual property products. In the first half of 2018, there's been an increase in investment in both software and R&D. And those are two areas that clearly impact upon future productivity growth. Firms are recognizing that in order to keep enjoying the level of profit growth that they've been enjoying recently, there's going to be less support from the global economy, less support from the Fed, so they're going to have to do it through productivity. And that higher investment in intellectual and property products, I think, is a real sign that firms are taking this idea seriously.
Brian, there was a lot of discussion, if staying on the investment for a second, that the tax cuts, some of the supporters of the tax cut said that will eventually lead to stronger investment growth because the corporations will be flushed with the liquidity. Do you think that has something to do with the acceleration we're seeing in investment, especially in intellectual property products?
So R&D investment actually receives less assistance under the tax plan because their R&D investment has always been expensible. So on the one hand, it is true that any profits firms earn, they'll eventually be able to keep more of. So that can generally lead to an increase in investment. But on the other hand, if the tax cuts were the primary driver, we would expect that equipment spending is where you would see the initial impact because the expensing provisions did become much more favorable. And instead, we've actually seen a first half weakening in terms of growth in capital equipment spending. Mm-hmm. So that's somewhat puzzling given the way in which the tax bill was set up. And we'll see, but I think it's way too early to try to assess the exact impact that the tax bill has had on investment spending.
Okay. So where does it put us? So this is our forecast table for the next year and a half. Where are we?
So we're at the peak of the current expansion. So in the second half of the year, we expect growth to be 3.3%. It's going to come down to 2.7 and 2.4 during 2019 in the first and second half. Consumption is going to remain quite robust for reasons that we're about to get into. But non-residential investment and residential investment will remain somewhat weak by recent standards. Non-residential investment may weaken as capital costs rise, and total government spending is also going to provide less support next year. So those are the key factors that lead to a conclusion that the growth outlook will remain strong in 2019, but it's not going to be quite as strong of a year as 2018.
Right. Should mention that our trend growth as estimate is around 2%. So through the end of 2019, we expect to still grow above trend. That's why we're expecting the unemployment rate to continue to decline and to be by the second half of 2019 at 3.6%, which would make it the lowest level since the 1960s. And perhaps with a tighter labor market, we'll also see inflation moving up. We are still expecting not to go well above the Fed's target rate, but there is a risk that the economy will overheat more than we expect and inflation will become an issue. So let's move to consumption and the outlook for consumption. What do you see the main points there?
So I think, as we've discussed, consumers are confident, labor markets are strong, tax cuts are certainly supporting spending growth in 2018. And the end result of all of those factors is that consumers have more spending power. They're going to be spending it primarily on discretionary categories. So those are areas like recreation goods, furniture, as opposed to staples, food at home, oil, and things like that, that consumer spending does not adjust as much to the business cycle. Tariffs could potentially lead to higher prices. Commodity prices could continue to remain more elevated than they've been in the past. We've seen an uptick in the price of oil. Upward price pressure is a bit of a double-edged sword. It helps boost up wages, but at the same time, it has the ability to reduce spending power. So all in all, the outlook for U.S. consumption is good, particularly if you're selling in a discretionary category. But the key thing to keep in mind is that as prices rise, as consumer credit becomes more dear, there is the potential that some of that greater spending power can be crowded out.
Mm-hmm. But in general, it's a pretty good period for the U.S. consumer, and we'll go into some details in a minute. But before that, let's look at our second poll question, if we can see it. So the question is, how much longer do you expect your sales to remain above average? One option is that our sales are at or below average levels. 6 months, 1 year, 2 years, longer. So we'll give you a few more seconds. 5, 4, 3, 2, 1, and the poll is closed. So 30% are saying that their sales are not above average. They are below or at average levels. But for those who are experiencing sales that are above average, it's kind of evenly distributed. The largest category say longer, so longer than 2 years. So quarter of our respondents expect this good period to be long lasting, but it's kind of more evenly distributed across the entire gamut here. What would you have voted for, Brian?
So I think that 1 year of optimism is sort of a good place to be, because eventually supply constraints are going to play more of a role in bringing down economic growth. In addition to that, higher interest rates and higher prices, they can eventually crowd out spending. So I think the view of our members makes a lot of sense, that either times haven't been quite as good in their sector of the economy as the total aggregate implies, or within 6 months or a year, there may be some pressure that may prevent the good times from just continuing to roll on indefinitely.
Mm-hmm. No, that sounds about right. So, Brian, what are some of the main drivers of consumer spending that our members should pay attention to?
So we've already talked about confidence. Confidence is high, and spending as a result is high. Real disposable incomes, represented by the red line in this chart, they've also picked up, partially as a result of the tax cut, partially as a result of higher rates of employment and some acceleration of wage growth. And that certainly benefits consumers and increases their spending power. As we mentioned, the labor market has tightened, and as it's tightened, more individuals have been able to get jobs. And as that green line, the employment cost index, shows, there is an increase in wage growth. So that's played a critical role in providing consumers with more opportunity to spend. How have the benefits from the tax cut been distributed? So we have seen that most of that benefit goes to the top quintile, both when you factor in the corporate and the individual taxes. Those will go towards members of the top quintile. So product lines that appeal particularly to those consumers should benefit most. However, Gad, over the short term, there's a very interesting wage growth phenomenon that could spread some of the greater spending power around a little bit. Could you elaborate?
Yeah. So we have a report coming out soon on that because I think it's an under-reported trend in the US economy, and that is we essentially have a tale of two labor markets. One is the blue-collar workers, blue-collar and low-paid services, where we're seeing a tighter labor market and a faster acceleration in wage growth for a couple of years now already. And the other is the white-collar labor market, where we are seeing a much more modest acceleration in wage growth. This is the opposite of what we experienced in most of the last several decades, where white-collar wages were actually accelerating faster than blue-collar. There are several reasons for that, which probably will have an entire webcast on that. So I won't do it justice in a few seconds, but I think the bottom line is that we are also the impact from the tax cuts were mostly distributed to the higher end of the income distribution, but in terms of wage growth, we are seeing a stronger recovery in the lower end because blue-collar and low-paid services jobs are seeing a significant faster acceleration in wages. That will boost their spending power, and we're likely to see some advances in that market segment as well.
And that's critical to keep in mind when you're assessing the impact of these good times on spending, because as that previous chart showed, 20%, more than 20% of the benefits from the tax cut are going to the top 1%, more than 60% to that top quintile. But the question then becomes, how long is it going to be the case that gap between the blue-collar wage growth and the white-collar wage growth continues? Because that can end up influencing how those spending patterns evolve. And indeed, what we can see in this chart is that those discretionary categories are growing much more quickly than non-discretionary categories, which is quite typical for a period of expansion. And as this next chart shows...
Just one more point on this. If you squint hard enough on the most recent year or so, you are seeing an acceleration in discretionary spending towards the 4% growth rate, whereas the non-discretionary spending stays at 2%. So perhaps the most recent acceleration in the US economy and the increase in confidence is shifting even more people towards discretionary shopping.
No, that's definitely true. And I mean, you can see that in some of the categories that have benefited most over the last year. So other durable goods, motor vehicles, and parts. So this chart is showing a 5-year growth average versus the last 1 year. But I think an important point that this chart shows is that, broadly speaking, during periods of solid expansion, which the last 5 years have mostly been, consumers continue spending at much faster rates in those discretionary categories relative to those non-discretionary categories. So all of these categories end up benefiting. Some are extremely highly correlated with GDP growth. So furnishings and durable household goods are, recreation goods are certainly in that category. But all of these discretionary categories benefit when times are good. However, there is the risk that some of this increase in discretionary spending may go away over the next year or so. So it's very likely that the Federal Reserve will act strongly enough to prevent inflation from taking off. You can see that the Fed's preferred core inflation measure, the PCE price index, which is the blue line, is just below its 2% target. Markets, as indicated by the 5-year inflation expectations, the green line, are not anticipating inflation to increase much beyond that 2% level anytime soon. But again, higher interest rates means more expense in terms of consumers being able to borrow on credit cards, on home equity loans. So in all of those ways, it cuts down on possibilities for consumer spending.
And finally, there are some other factors like the stock prices and the oil prices that are also impacting consumption.
Absolutely. So on the one hand, stockholders are feeling wealthier and wealthier. And as you saw also from the house price slide earlier, housing prices have increased. So you get a wealth effect both for homeowners and stockholders. And that definitely helps buoy consumption. On the other hand, oil prices are considerably higher than they were last year. So that's going to cut down on the amount of space consumers have to enjoy discretionary spending, especially if those prices rise higher. And I want to draw your attention to the Wall Street Journal dollar index, the green line, because as the dollar gets stronger, as it keeps appreciating, what that's going to mean is higher prices for US imports. And many of those are going to end up being in non-discretionary categories. Some of them will be in discretionary categories. But regardless of the case, higher prices naturally mean less spending. And what also compounds that risk is the ongoing trade conflict. We've already seen in terms of washing machines prices rise. If tariffs end up spreading into the auto sector, that's going to be an even greater problem in terms of pricing out some consumers and perhaps reducing spending. So all in all, expect continued strong spending growth through 2018 and perhaps into 2019. We don't see the labor market turning around all that quickly. But given a strengthening dollar, possibly higher oil prices, possibly increased prices for some goods and services as a result of tariffs, all of those things create risk around this otherwise rosy outlook for consumption, particularly discretionary consumption.
Thank you very much, Brian. So hopefully our audience got our main message about consumption, but also at the same time, we discuss some of the complexities and the specific factors that are impacting consumption and are likely to impact different industries in a different way. So a lot to digest. Just before we conclude, I want to remind you that this Economics Watch series is here every month, and we will continue to do that in September, and for the remaining of this month there will be the regular deliverables. Our next Economics Watch is going to be here on September 12th. Can the US keep its upward momentum? A sneak peek into 2019. So it will be a more forward-looking webcast. And a few other things that we thought you may be interested in to learn more about the economic and outlook and other related material here from the conference board. So I want to thank Ilaria and Brian for being with me today and delivering this interesting webcast, and I want to thank our audience for being with us today, and you can now go back to the beach or the mountains or wherever you're going to spend the rest of the month. So thank you and have a good rest of the day.